Hello, David Moore with Equity Advantage, and I'm here with Robert Smith of Peregrine Private Capital, and we're talking all things real estate today. January of 2023. See, I did it.
Bingo.
I did it. I want to be back on vacation, but one of the things that always it just blows me away is all these politicians proposing going like mark to market on stuff, and it's like, okay. And we deal with this issue with distribution. So that our IRA 401k business, when people start taking distributions, you get to a certain age, you got to take those RMDs, required minimum distributions and all. And in the Wall Street world, it's really always going to be cash, right? That's all they look at. Well, in my world, there's lots of in-kind distributions. Well, we've talked about before. My youngest brother is a MAI appraiser, Master Appraisal Institute certified. He does new house, just does big stuff. And for those of you on our channels that subscribe, please like and subscribe. The stuff really helps us out, and also you help us understand what you want to see. But I've said many times, is like, hey, Greg, how do you know when you've done the right job on the valuation? He says, well, really easy. I said, well, what do you mean by that? He says, nobody's too happy or too mad, right? So if you've got a real estate transaction, you've got a buyer and seller agreeing to a value. Okay, if you don't have that, what is a piece of property worth? And everybody's so happy that things have gone from this value to this value. Well, if they go mark to market on you, number one, how do they establish what that thing's worth? If it's real estate, because it's not a set number there. But what good is it to you to have something go way, way up in value if you're just going to hold it and now you're stuck paying the property taxes on it, or if you go to sell it? You think about Section 121, the universal exclusion that was put in place in 1997, really.
When dinosaurs were on.
Yeah, so 250,000 individually, $500,000 for a married couple in 1997. That meant a lot, right? Today it means nothing. I mean, it means absolutely nothing. So for those of you out there that have commercial property, you're probably watching these things thinking about your investments and, hey, I'm going to sell this. I don't want to pay the tax. And this is why I'm going to listen to what's being talked about on Upreats, DSTs, whatever we're talking about today. But let me throw this back at you. If you sold your home today, would the 250 or 500 cover that tax consequence on the disposition? And have you even thought about that, and what options do you have? Well, one option is something we always talk about in the 1031 space, is to convert the asset from your residence into an investment. And a lot of you may have done that already with a portion of it. Through COVID, you might be working at home. And if you sold your home and you've been treating that piece of your home as a home office for more than 3 out of the preceding 5 years, 121 applies to anything you've lived in for 2 out of the preceding 5. So if you convert something and you move out of it, you got to sell it within 3 years to realize to take the exclusion still. But what we have a lot of people doing now is they don't want to take the exclusion. They're going to move out, convert the entire asset, or they're going to use a piece of that home as investment. Or another option is the Upreat. And that's something that I'd like you to, or not the Upreat, I'm sorry. The Upreat's a nice way to turn a sale into an installment sale. I think it's the ultimate installment sale. The QOZ, Qualified Opportunity Zone, or OZ, Opportunity Zone, I think is a nice option for people that don't want to move out of the house, convert the thing, and have gains well in excess of the 250 or 500. So, the idea is look at this stuff, understand the inflation's done a variety of things. And one of them is jacked up the value of properties beyond what they're really worth. And the consequence to you is you're thinking, hey, this is great. I've got all this stuff. Your dollar's worth less than it used to be. Your home's going to trigger taxes now. And what do you do with that obligation? So really take advantage of the financial, advisors in your world, your tax people, number one. Understand what's going to happen if you go to sell something, the tax liability, and really understand what your options are, that menu of end games that are available to you. And don't just take it and say, well, I'm stuck. So you offer a variety of investment options for people. Some are being pushed by different entities more than others, and I guess what I'd like to ask you to explain a little bit to people is, sort of the menu of things that are out there and why one offering might be presented or pushed harder than another offering from somebody in the financial services world.
Well, I think what's important to understand is the current size of the DST market. And DSTs are not a Wall Street product. DSTs not only were invented on the West Coast and Midwest, the two companies present in the creation of DST, Pasco out of Southern California, and the Inland Group out of Chicago. And the product really started west of the Rocky Mountains and moved east. From a transaction standpoint, we did over $10 billion in transactions last year. I believe that's the number. And so, for better or for worse, in our opinion, the latter, that got Wall Street's attention because now the numbers are starting to get pretty serious. And none of the wirehouse or mainstream brokerage firms, the captive broker-dealers, meaning Ameriprise, J.P. Morgan, Morgan Stanley, none of these people platform DST product. Their reasoning has always been it's too small, it's too idiosyncratic, it's too opaque. I think the real reason is, I'm cynical, is it's illiquid. Again, it's dead money. Once your money goes into real estate, if it's doing what it's supposed to do, it's going to be there for a while. So it's not available from a trading standpoint to buy and sell, to generate income the way Wall Street makes income. But because the DST industry is very big now, they want a way in, and their way in has been with the Upreat, specifically the Ares Upreat, which is the only 1031 specific product, I believe, that most of the big broker dealers will put on their platform.
So Bob, just real quick, sorry to interrupt you. So everybody understand what a REIT is, number one, and what's an UPREIT?
Okay. UPREIT is simply, it's Section 7.
What's a REIT first?
Oh, REIT is simply, that's just an acronym for Real Estate Investment Trust.
And can we exchange into a REIT?
You cannot exchange directly into a REIT because you have to have a clean 1031 exchange. It has to be direct ownership of dirt for direct ownership of dirt. And when you buy shares in a REIT, you're doing just that, buying shares of a company that owns the dirt. And it's that intermediation that historically has disqualified REITs for 1031 exchange purposes.
So what's an UPREIT?
An UPREIT is you do a 1031 exchange into a specific DST property, which in turn is tied to a 721 UPREIT. And then, a year, 2 years, 3 years, however the UPREIT is structured, that DST property and your fractional interest will be absorbed into the UPREIT via a tax-free 721 exchange, and that fractional interest will then be converted to operating units of the REIT. So that's an indirect way, a two-step way to access a REIT via first a 1031 exchange, then a 721 exchange. And historically, the UPREIT has been people's end game, meaning when you are of an age where you no longer intend to do any more 1031 exchanges, an UPREIT is entirely appropriate, because once your fractional interest of a DST property is converted into operating units of the UPREIT, you cannot exchange out of the UPREIT. You have to convert operating units to shares of the REIT, sell the REIT shares back to the REIT operator, and pay capital gains tax liability there. And so it's an end game for someone, again, who does not intend, is old, at a point in life where they no longer intend to do any more 1031 exchanges. It's entirely appropriate. However, we think the rub is that because the big captive broker dealers do not have the universe of DST product that the independent broker dealership chain does, their brokers will only show one product to an investor. Someone comes along, happens to mention that they are about to sell an income-producing property. Oh, you need to do a 1031 exchange. This is what you need to do. So they're not misrepresenting things to them, because at the right point in time in life, an UPREIT is entirely appropriate. They're simply not telling them all the truth, exposing them to the universe of other product that we think is demonstrably better that is available. So it's important for investors looking at the Upreat as a 1031 exchange option, understand that it is part of the story, but is only a very, very small part of the story.
So we look at it. The reason I like Upreats, if somebody comes to me and say, look, I don't want to do an exchange, I want to just maybe carry a note in trust or land sale contract. So I want to do an installment sale, and therefore I want that note, let's say, payable over 10 years. Number one, I guess you better make sure you got enough down payment where you're comfortable with what the buyer's going to do. But number two, you better have an acceleration provision in that thing. Number three, when I talk about enough of a down payment, understand that if you just do an installment sale, you're going to obviously got to pay all the vendors involved with that sale. So your broker probably wants to get paid. Your escrow officer wants to get paid. If you're doing an exchange, I'd like to get paid. So make sure you got enough to at least get you out of escrow with some money. But also understand that if you gave up a property and you sell on an installment sale and let's say it's an improved property that's got debt on it, you're going to pay tax on debt relief and depreciation recapture in your disposition, even if you didn't receive a single principal payment. So the Upreat is wonderful because you're completing an exchange into a DST that then at a later date gets rolled into this real estate investment trust, and that rollover via 721, that's not a taxable event. The tax event happens when you decide you don't want those shares of the REIT anymore. So, and literally you pay tax on those shares as you sell them, which could be all in a year, it could be over 10 years, could be whenever you want. So, I mean, I just look at it as the ultimate installment sale. Right. But understand that you do have a REIT, and the shares of the REIT can go up and down in value. But, with that said, it is an end game, as Bob said. You're sort of pigeonholed in. As soon as you do that conversion, there's no way out without tax. Now, is every DST or every DST that offers that Upreat option, is it all you have to do it, or are there somewhere you've got the option to do it?
It's obligatory. It is the only option available to you.
So anybody in that DST offering is going to go for that.
It's going to be rolled into the Upreat. Yeah. Initially when a company or two introduced Upreat into the DST space, there was an option to not exchange into the Upreat, but that has subsequently changed, and going forward, it's your only option. Yeah. It's obligatory.
So I sort of look at 1031 as the real estate world's IRA or 401k, right? I mean, Wall Street will complain, well, gee, we don't have 1031, so why should you have 1031? Well, we don't have all that qualified money. We obviously have some qualified money in real estate, but not that much, where a huge chunk of Wall Street's money is IRA 401k funds. The reason I bring that up is that you've got the ability to go to cash in and out of cash with qualified money with total tax deferral. It's a nice thing. With the real estate, you're looking at you can pull money out. So a lot of times in these times, people say, well, gee, the property's maybe being beat up in value a little bit. Maybe you just sell it and let's throw the money to Wall Street because stocks have been beat up. And my response to that is, look, you're giving up probably 40%. If it's a long-term gain of what you just had. How long is it going to take you to make up what you just paid in tax? I would encourage people to look at, if you're saying, hey, gee, I'd like to get money back into Wall Street, do something like that, I'd encourage you to look at doing a cash-out refi and doing it that way. And the equity left in the property that would have been lost to tax is now equity in the property. So I like that deal. But I think that Upreat's a great way for people to get rid of things, get the installment sale treatment, and literally pay a tax. And by the way, at least the way the world is today, it gets attacked every few years. You can still swap till you drop. So, if your heirs, if you pass away during that acquisition of the DST and roll over into the Upreat, and maybe you're sitting there with shares of the REIT at that point in time, if you pass away, your heirs can then liquidate those shares and not have a tax consequence. So that could be a very attractive end game for somebody that's saying, look, when I pass, I don't want my kids to be encumbered by all this real estate. Maybe this is a way to get them, get your estate planning done, diversify into some more Wall Street offerings without tax consequences.
Correct.
So take that. Options, right? It's all about options and education. A lot of this stuff people just are not aware of. My father used to say, anytime you read anything about anything you know about, you know how wrong it is. So when you've got questions out there, please don't hesitate to reach out, ask the questions. If we don't have an answer for you, we're going to find an answer. But don't take it. Don't just take somebody's opinion on something and say, well, gee, you got to sell this thing and go do this, and selling it's going to trigger this big tax. Really take advantage of the resources that are out there. Ask the questions, and really take the time to understand what's possible.
Yeah, these videos are intended to be a predicate for further learning. It's a platform, an introductory platform to give you a place to start in terms of researching more information and becoming as fully informed as possible before you start pulling triggers and doing things that cannot be reversed. So it's critical.
So I want to thank you for joining us today. And like I said earlier, please like and subscribe. It really helps us out. You can take a look at YouTube, Peregrine Private Capital, or Equity Advantage 1031. You're going to find our information. We also have IRA Advantage on there. But Bob, thank you very, very much for joining us today. And it's always great to just spend the time. And we do sort of spin out a little bit, but I hope we're getting you great information. And as I stated earlier, if you got questions, please don't hesitate to reach out. Bob, if they want to reach you, how do they get a hold of you?
RS at Peregrine Private Capital, or just 503-241-4949. And I would like to say thank you. And thank you, David. And thank you, CC, his lovely daughter, who is the prettiest face at the table. Unfortunately, she's behind the camera.
That's not saying a lot.
Instead of in front of the camera, okay?
Yep. Happy New Year, everyone.
Happy New Year.
Thank you. Bye-bye.